Right. So it is mid-March 2026, and the diagnostic tools that typically run the U.S. economy are just flashing red across the board right now.
Yeah, completely red.
And the equity markets are in this state of what analysts are currently calling, I think the term is kinetic discovery.
Which is really just a polite way of saying the market is trying to price in an active war, slowing economic growth, and an aggressive central bank all at the exact same time.
Right. All at once.
Exactly. Traditional market correlations are just fracturing right in front of us.
And trying to make sense of that fracture is exactly what we're doing for you today. We've got a massive stack of real-time market reports, geopolitical updates, and financial data sitting right here.
A lot to get through.
Yeah, a ton. Our mission for this deep dive is to untangle a truly historic week, a week where a kinetic war in the Middle East over the Strait of Hormuz collided head-on with a really hawkish Federal Reserve.
This is a perfect storm, really.
It was. So we're going to break this down for you into 4 distinct parts. We'll do a daily timeline of this macro chaos, then the idiosyncratic stock movers, the aggressive flight to alternative assets, and finally, a deep dive into the week's financial results and corporate catalysts.
That's good.
Okay, let's unpack this.
So, to really understand the day-by-day whiplash we saw this past week, we kind of have to start by pouring the macro foundation.
Right.
Because the market isn't just reacting to war headlines in a vacuum. It's reacting to those headlines landing on top of some genuinely troubling economic data.
Which data specifically?
Well, the Bureau of Economic Analysis just significantly revised its estimate for fourth quarter 2025 GDP growth. They revised it all the way down to just 0.7%.
Oh, wow. Which is a massive drop, right? I mean, the initial estimate was 1.4%, and I think the general consensus on Wall Street was like 1.5.
Yeah, 1.5.
So how did we get it so wrong? Why the sudden drop to 0.7?
It's the delayed hangover from the record-long government shutdown we experienced in the final months of 2025. Yeah, when the government stops paying workers and freezing federal contracts, it creates this massive localized recession. That shutdown essentially subtracted a full percentage point from the real GDP growth rate.
That makes sense.
So the crucial context here is that we're entering a major geopolitical crisis with an economy that was already decelerating.
Right, like the engine was already sputtering before we hit the hill.
Exactly. But here is the terrifying kicker for policymakers. While growth is slowing to a crawl, inflation is just stubbornly persistent.
How bad are we talking?
Well, the Core Personal Consumption Expenditure Price Index, which everyone just calls Core PCE, it hit 3.1% year over year in January.
Just to pause there and clarify for everyone listening, the core PCE is the Federal Reserve's absolute favorite way to measure inflation, right? Because it specifically strips out the volatile prices of food and energy.
That's right. It's designed to show the underlying sticky inflation in the everyday economy.
Which makes that 3.1% number incredibly alarming. Because if core PCE strips out energy, that means inflation was running hot at 3.1% before this massive oil shock in the Middle East even started.
Exactly. And the Fed's target is 2.0%.
So we have economic growth slowing to 0.7% and baseline inflation running at over 3%. I mean, that is the literal textbook definition of stagflation.
It is. The dream of a smooth disinflationary glide path in 2026 is virtually dead. And that underlying macroeconomic tension is really what drove the daily seesaw we witnessed in the markets from Monday to Friday.
So let's walk through that timeline because it was pure whiplash for anyone watching the tickers.
Oh, absolutely.
Monday actually started with a head fake. We saw a massive relief rally. The S&P 500 climbed a full 1%, which was its best single session since the conflict in Iran began.
And the mechanism behind that rally was entirely tied to a brief cooling in energy prices. Oil actually dropped 5.3% on Monday to settle around $93.50 a barrel.
Right. There were these rumors floating around the trading desks that commercial vessels had successfully navigated the Strait of Hormuz over the weekend.
Just rumors, though.
Yeah, the market took that tiny, completely unverified glimmer of hope and sprinted with it. Tech led the way, obviously. NVIDIA pushed this AI resilience narrative, with their CEO projecting $1 trillion in AI chip revenue through 2027.
It really felt like traders were desperately trying to close their eyes and just get back to business as usual.
But reality set in on Tuesday.
It did. Though Tuesday showed some very unexpected durability. Oil prices resumed their violent climb as the fighting escalated in the Gulf, but the S&P 500 still managed to eke out a 0.2% gain.
Which completely breaks the normal rules, right? Usually if oil spikes, equities drop because high energy costs just eat straight into corporate profits.
Precisely. That standard inverse correlation temporarily broke down.
Yeah.
Equities just stubbornly held their ground.
Until Wednesday.
Right, until Wednesday. Wednesday was the pivot. We had the FOMC meeting the Federal Open Market Committee, which is the group at the Fed that decides whether interest rates go up or down.
And they held rates steady at the 3.50 to 3.75% range, which wasn't a surprise. I mean, everyone expected that.
Yeah.
But it was Chairman Powell's tone during the press conference that completely changed the mood in the room. He talked about a low-fire labor market colliding with a supply-side energy shock.
He was incredibly blunt. He noted that while the Fed historically tries to look through sudden energy spikes, treating them as temporary, the fact that inflation has been above their target for 5 years makes it nearly impossible to ignore this new oil surge.
Right. They can't just brush it off anymore.
Exactly. And then the Fed released their new dot plot.
For those who don't watch Fed meetings for fun, the dot plot is literally just a scatter plot chart where every Fed official places an anonymous dot to show where they personally think interest rates will be at the end of the year.
Right. And the new cluster of dots showed only one rate cut for the entirety of 2026.
Wow.
Yeah, that realization hit the market hard. But there was another massive layer to Wednesday's sell-off, which was institutional uncertainty. Powell's term as chairman concludes in mid-May, and Kevin Warsh has been nominated to succeed him.
Right, and the market is aggressively pricing in what the reports are calling a Warsh premium. So why does Warsh command a premium?
Well, because Kevin Warsh is a known historic inflation hawk. He was at the Fed during the 2008 financial crisis and has been highly critical of easy money policies.
Okay, so the market mechanism here is anticipation.
Yes, exactly.
Yeah.
Traders assume that if Warsh takes the wheel, he'll prioritize killing inflation at all costs, even if it means sacrificing GDP growth. They're pricing in a much tighter, more restrictive money supply.
And compounding that anxiety, Powell cited an active Department of Justice investigation into the central bank as his reason for remaining on the Board of Governors until it concludes.
Yeah, that was huge.
I am still trying to wrap my head around that. A DOJ investigation into the central bank. That introduces a level of political risk that we just do not see in modern American monetary policy. It completely shakes the foundation of central bank independence.
It really does. So the market is trying to digest stagflation, a hawkish new Fed chair, and a DOJ investigation. And then we hit Thursday and Friday.
The triple shock.
The triple shock. You have the hawkish realization from the Fed, the confirmed total military closure of the Strait of Hormuz, and then the devastating news of a massive attack on a Qatar LNG facility.
And by Friday, the floor just fell out. The S&P 500 closed at 6,632.119. The macro situation right now, I mean, it's like trying to drive a car while the engine is flooding and the brakes are cut.
That's a great analogy.
The Fed desperately wants to throw water on the slowing 0.7% economy by cutting interest rates. But because of this massive oil shock, that water will just hit the grease and their inflation fire will explode in their faces. They're trapped.
Policy trap is the exact phrase economists are using. And that trap is forcing a violent sectoral bifurcation. We're seeing institutional capital violently rotate out of defensive bond proxies like utility stocks, which dropped 5% on the week, and they're piling into hard commodity producers like energy, which actually gained nearly 3% despite the broader market crash.
It is a historic shift in how capital moves. And, before we zoom in on the specific companies, if you're finding this breakdown helpful in navigating this incredibly chaotic market, make sure to hit subscribe and like the video.
Definitely.
It directly tells the algorithm that you want more of this deep, impartial analysis to help you stay ahead of the curve. Because as we shift from the macro view down to the micro view, the mechanics get even more fascinating.
They do. The micro data, like the individual corporate earnings, often tells the truest story of how these macro policies are actually hitting the real economy.
Right. So if the macro environment is a flooded engine, how are individual companies managing their own vehicles? Let's look at the idiosyncratic stock movers and financial results. Catalyst number 1, Micron Technology, ticker MU.
This was wild.
This one blew my mind. Micron releases their earnings, and their top-line revenue nearly tripled year over year. Tripled. They're supplying the chips for this massive AI infrastructure build-out.
Yep.
Yet after announcing that their revenue tripled, the stock dropped 3.8%. Explain that to me. If a local lemonade stand triples its sales, the owner is thrilled. Why is Wall Street punishing a company for tripling its revenue?
It's a great question, and it all comes down to the underlying mechanism of capital expenditures, or CapEx.
Okay.
Management announced they plan to spend over $25 billion this fiscal year and even more in 2027 just to build the physical factories and expand production capacity to meet that AI demand.
Right, but you have to spend money to make money.
True, but we are now in a structural, higher-for-longer interest rate environment. In a market where capital is incredibly expensive to borrow, dropping $25 billion in CapEx terrifies investors because it destroys free cash flow.
Got it.
Free cash flow is the money left over after a company pays for its operating expenses and its capital expenditures. If Micron is spending $25 billion on physical infrastructure while interest rates are sitting at 3.75%, the risk to their balance sheet is immense.
So it was a classic sell the news reaction.
Exactly. It proves that even the mighty AI trade is tethered to the gravity of high interest rates.
That makes perfect sense. The cost of capital is finally biting the tech sector. But then we have Catalyst 2, which feels like it defies gravity entirely. Delta and American Airlines.
Yeah, huge surprise.
We're in the middle of a massive global energy shock. Jet fuel prices are obviously skyrocketing. Yet on Tuesday, both of these airlines actually raised their revenue forecasts. How is that mechanically possible?
It highlights a fascinating delay in consumer psychology. Despite the inflationary pressures, the early week data show that consumers have not yet pulled back on travel.
Wait, really? People are still flying that much?
Yeah. The airlines raised their ticket prices to cover the jet fuel, and consumers simply absorbed the higher costs. It's a testament to this post-pandemic phenomenon where people prioritize experiences over physical goods.
Though the open question is how long that psychological resilience can last if baseline inflation breaches 4%.
Right. Eventually, the consumer taps out.
Which perfectly transitions us to Catalyst 3 Abbott Laboratories, ticker ABT. Because Abbott is making a move to protect itself against exactly that kind of consumer exhaustion. They announced a massive $21 billion acquisition of Exact Sciences at $105 a share.
This is a textbook defensive pivot. From a purely financial perspective, the acquisition actually hurts Abbott in the short term. It dilutes Abbott's 2026 adjusted earnings per share by about 20 cents.
Okay, so EPS dilution just means that because Abbott is issuing new stock or taking on debt, I think in this case $1.8 billion in net debt, the slice of profit assigned to each individual share gets smaller.
Correct. And typically, the market hates EPS dilution and will immediately sell the stock.
But they didn't hate this move.
No, because it secures Abbott's undisputed leadership in the $60 billion cancer screening market. Yeah. Specifically by acquiring the Cologuard product.
Ah, okay.
Look at the macro environment. High inflation, high rates, consumer exhaustion. In that environment, institutional investors want certainty. They want high-margin, non-discretionary revenue streams.
Right. People might skip a Delta flight to Europe if money gets tight, but they do not skip their oncology diagnostics. Abbott is basically buying a massive inflation-proof moat.
That's exactly it.
That is brilliant. So if healthcare is non-negotiable, what happens to the companies relying on the money people have left over after paying for the necessities? That brings us to Catalyst 4, Ulta Beauty, ticker ULTA. This was the major laggard of the S&P 500, plummeting 14.2%.
This perfectly illustrates the breaking point of the everyday consumer. The Bureau of Economic Analysis data showed the personal savings rate rising to 4.5%. Consumers are actively hoarding cash right now.
And the primary mechanism driving that fear is the gas pump.
Oh, absolutely.
The sources note U.S. pump prices are up 30%, heading rapidly toward $4 a gallon. And that completely shattered the beauty resilience thesis. There's this old economic concept called the lipstick effect, right? Which suggests that cosmetics are an affordable luxury that survive recessions because people still want small treats.
Yeah, but when it costs $70 just to fill your tank to get to work, that thesis dies. Those retail margins at Ulta get eaten alive. Discretionary spending is always the first casualty of an energy shock.
Which logically leads us to our fifth catalyst, Western Digital, ticker WDC. They surged 9.64%.
Yeah, and this is where the geopolitics we mentioned earlier directly influences a single stock. Western Digital suddenly became a safe haven hardware play.
Right. The reports note they have a highly favorable SMART score, which is an aggregate quantitative rating system tracking fundamentals and sentiment. But the real mechanism driving the stock is their logistical moat.
Right. They're a U.S.-based hardware manufacturer. Their supply chains are largely insulated from the disruptions in the Strait of Hormuz. Suddenly, physical, secure supply chains are worth their weight in gold.
That concept of seeking security is the perfect transition to the broader asset classes, with equities rotating violently from growth tech to defensive energy and secure hardware. Institutional capital had to find new homes.
And the alternative asset space, commodities, bonds, and crypto experienced absolute whiplash.
Let's start with the geopolitical reality driving this flight of capital. We are looking at this purely through the lens of market mechanics and asset flows, staying completely neutral on the politics, but the physical events themselves are just staggering.
They really are.
Iran struck the world's largest liquefied natural gas, or LNG, plant in Qatar. That single facility accounts for nearly 20% of the global LNG supply.
And we have to understand how the LNG market works to grasp why this is so catastrophic. Liquid natural gas isn't like crude oil, where you can just pump more through an existing overland pipeline.
Right.
It requires massive, specialized, multi-billion-dollar cooling facilities to liquefy the gas, load it onto specialized cryogenic ships, and then regasify it at the destination. When you blow up the facility that processes 20% of the world's supply, you cannot just route around it. The infrastructure is gone.
Wow. And buyers across Asia and Europe completely panicked, sending Brent crude spiking to $119 a barrel as a proxy energy hedge.
The International Energy Agency tried to calm things down by releasing 400 million barrels of emergency reserves, but the market barely blinked. It made no dent.
But what did move the market was the algorithmic reaction to political statements. President Trump issued a 48-hour ultimatum threatening to obliterate Iranian power plants if the Strait of Hormuz wasn't reopened.
The market instantly priced in a massive regional escalation.
But then, just hours later, he walked that statement back, stating the U.S. was actually considering winding down military efforts. And the market reaction was entirely mechanized. The S&P 500 ETF, the SAPY, posted a massive, immediate reversal in after hours, trading the exact second that winding down comment hit the wire.
It's fascinating. You literally have quantitative trading algorithms utilizing natural language processing to parse the tone of diplomatic statements and instantly execute billions of dollars in trades in milliseconds.
It just removes the human element of hesitation entirely. And while the equity algorithms were busy chasing geopolitical headlines, the bond market was screaming a very clear fundamental warning about inflation.
Yeah, inflation fears drove the 10-year U.S. Treasury yield up to 4.39%, and the 2-year note climbed to 3.88%.
What does that climbing yield actually tell us about investor sentiment?
Well, it tells us that investors are demanding to be paid more to lend money to the U.S. government. We have to remember that total U.S. federal debt just crossed $39 trillion.
Right.
When you have $39 trillion in debt, slowing growth and rising inflation, institutional investors demand a much higher credit risk premium. They're basically saying, if you want my money for 10 years, you have to pay me 4.39% to compensate for the inflation risk.
Yet, amazingly, the corporate bond market stayed highly active. Novartis managed to launch an $11 billion debt deal in the middle of this chaos.
Because capital still has to flow somewhere to generate a return. And a massive amount of it flowed into gold.
Yeah, gold acted as the ultimate war hedge, hitting a historic $5,246 per ounce early in the month.
Gold did exactly what gold is supposed to do. It's a non-fiat store of value. When government-backed currencies and corporate equities look incredibly vulnerable to war and inflation, capital flees to a physical asset that cannot be printed or destroyed.
Though it did drop about 10% late in the week as those diplomatic whispers of peace talks started emerging. But then there's crypto. Specifically, crypto's massive identity crisis. Bitcoin completely collapsed below $68,000 immediately following that initial obliterate threat from Trump. Over $240 million in levered crypto positions were liquidated in just 60 minutes.
Ouch.
Yeah, so I have to ask, what does this actually mean for crypto? For years, we've heard that Bitcoin is digital gold, a safe haven from traditional market chaos. But here, it just traded like a high beta tech stock, meaning it just moved like the Nasdaq, but on steroids.
You're exactly right, and it exposes a massive narrative tug-of-war within the crypto space.
Oh, so...
The decentralization advocates desperately want Bitcoin to be a safe haven from fiat instability, much like physical gold. But the mechanical reality of the trading data shows a completely different story. Rate hikes and geopolitical fear are entirely overpowering that decentralized narrative.
How does that actually play out on the trading floor, though?
Well, when fear spikes in traditional markets, liquidity dries up. Institutions get hit with margin calls, meaning their brokers demand more cash to cover losing positions in equities or bonds.
Right. Because Bitcoin trades 204/7 and is highly liquid, Institutions treat it like a speculative technology asset. They dump their Bitcoin simply to raise the cash they need to cover their margin calls elsewhere.
Wow. So it's not a safe haven at all. It's basically an ATM they use to cover their traditional market losses. Yeah, it is the ultimate reality check.
Exactly.
So bringing all of these threads together, we've looked at the flooded engine of the macroeconomy, the specific companies building moats or getting burned by consumer exhaustion, and the violent swings in commodities and digital assets.
If we have to distill the primary lesson from this unprecedented week across all these sources, it's that we are firmly, structurally entrenched in a higher for longer reality.
Yeah.
The AI trade, which blindly carried the market for the last 2 years, is now facing incredibly strict CapEx scrutiny because capital is fundamentally expensive. And broadly, institutional capital is fleeing from speculative growth and seeking out direct physical commodity exposure and defensive cash-flowing assets. It is a totally new paradigm. As always, this deep dive is for informational purposes only. The markets are incredibly volatile right now, as we've clearly seen with the algorithmic swings and geopolitical shocks, so please do your own research and deeply understand the risks before making any investment decisions.
The landscape is quite literally shifting daily, and rigorous risk management is paramount.
Absolutely. And I want to leave you with one final unexplored thread to mull over. We talked about how Western digital surged because suddenly having physical supply chains and US-based manufacturing is more valuable than just having great software code.
Right.
If geopolitical fragmentation and structurally high energy costs become the permanent new normal, what happens to the multi-trillion-dollar valuations of purely software-based AI companies, the ones that rely entirely on the assumption of cheap, borderless global computation? If the hardware and energy required to run these AI models become permanently expensive, maybe the software itself doesn't command the premium we thought it did. Something to chew on.